Knowing what you know now, what would you have done differently in 2023? Now, if you're like most of us, there are probably lots of things you would have done. But today I'd like to focus on property and investment. And let's look back at the lessons I learned over the last year, 2023. And to be honest, some of these things I had to relearn. But taking them into this new year should make me and you better property investors. And as I share them with you, I hope you're going to get some direction, some certainty, because we've got a challenging year ahead for our property markets. Now, regular listeners would know I usually have a guest on the Michael Yardney podcast. However, today it's going to be just a chat, just me and you, as I share 23 property investment lessons from 2023 that you don't want to forget. So welcome to today's show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment, and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect, and pass on your wealth through strategic property and wealth advice. Now, here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
It's that time of the year when it's a good time to look back at the year that's been and learn some lessons. Of course, each year brings its own wins, its own challenges, its lessons to learn. And boy, 2023 wasn't an exception, was it? In fact, it was an extraordinary year, wasn't it? Look, remember a couple of years ago when our attention was focused on COVID-19 and its impacts on our lives? And then in 2020 and 21, we had a massive property boom. Then 2022, property values started falling and interest rates started rising. Well, 2023 will go down in history as the year when booming migration led to a shortage of dwellings, causing property values to rise and rents to skyrocket. However, looking back at the end of 2022, who would have thought that we'd have so many more interest rate rises, inflation would remain stubbornly high, and yet unemployment would remain at historic lows, and our housing markets would be so resilient? Or who would have thought there'd be a war on the other side of the world that would last for over 2 years between Russia and Ukraine, and now another war in the Middle East? Nobody could have foreseen all that's happened, including the severe slump in consumer confidence that occurred throughout 2023 because of all the uncertainty, including the economic uncertainty and the worries about interest rates and inflation. But as we head into 2024, I can't help but reflect on what Australia as a country, what we've accomplished and what I've personally achieved and what I've overcome and the lessons I want to carry into the new year, into 2024. So here are my top 23 lessons I want to remember from 2023. And the first one, of course, I think we remember this every year, is to expect the unexpected. Every year brings an unexpected X factor. It comes out of the blue to undo the best laid plans. Now, sometimes they're on the upside. Remember, back in 2019, there was a miracle election result and all the doomsayers about property were wrong when Labor government didn't come in and we didn't get the changes to negative gearing. So sometimes the X factors are on the upside and sometimes they're on the downside, like COVID-19 in 2020, or the war in Ukraine, or the Middle East war, or our souring relationships with China, our major trading partner. Now, strategic investors try and protect themselves from these surprises by owning the best assets they can, by having financial buffers in place to ride the ups and downs of the property cycle, by setting up the right ownership structures, by insuring themselves, and by getting holistic advice, obtaining holistic advice from their consultants. But the biggest risk is the one that no one sees coming. So sure, you try and cover your risks, but if no one sees it coming, then you can't be prepared for it. And that way, I guess, in many ways, its damage can be amplified when it arrives. So while an X factor comes every year, and be prepared for that, I've realised that over the years, looking back, a major black swan event, as some call it, and one that breaks the world, tends to come every decade. And you can look at COVID, you can look at the global financial crisis, things like that. So my lesson, the first lesson, is be prepared for the X factor. The second lesson of the 23 lessons I want to take into the new year from 2023 is focus on the long term. The strong performance of our property markets just reminded us to ignore the numerous pessimistic predictions by the so-called experts who predicted real estate Armageddon. I learned a long time ago that if you read the predictions of last year and see how they transpired, you really wouldn't pay too much attention to the predictions for this year. In fact, you'll learn more from reading history than you will from reading forecasts. Now, of course, it's hard to ignore the forecast when the media continuously reminds you about how dire our situation is, but I've also learned not to make 30-year investment decisions based on the last 30 minutes of news. Strategic investors, they've got a long-term focus. They don't change their plans on what's happening now. So as I said, the second lesson really is focus on the long term. So while the average Australian focuses on what they're going to do next weekend, and some investors wonder about what's going to happen in 6 months' time or 6 weeks' time, strategic investors aren't concerned about that. They're looking at where the markets are going to be in 10 years' time, in 20 years' time. So I guess what I'm getting at is don't buy investments that are working now. Strategic investors buy the type of assets that have always worked rather than where the next hotspot is. Again, it's at this time of the year that all the predictions come out about the top 5 spots in Sydney this year or the 4 best areas to buy in. Don't chase the next shiny toy or the next hotspot. Clearly, this was the thinking behind Warren Buffett's quotes when he said, "Be fearful when others are greedy and be greedy when others are fearful." Of course, while it's easy to say, it's not easy to do. The third lesson I'd like to take into 2023 is it's the media's job to entertain you, not to educate you. Remember, it's the media's job to get eyeballs on their advertisers' content rather than to educate you. And that's why you'll find so many negative, so many scary headlines. Remember all the forecasts and predictions of a property downturn in 2023? Not just from the regular property pessimists, from the bank and the Reserve Bank economists. Yet, how many of those experts' forecasts came true? What happened to those forecasts of the fiscal cliff, the unemployment cliff, the fixed rate cliff, the mortgage stress, forcing floods of distressed properties in our markets? But look how many people worried, look how many people stressed about the potential outcomes that just didn't occur. And unfortunately, being overwhelmed with information led many investors, many people, to live in a state of fear and anxiety and caused some disastrous investment errors. Remember, many people sold up and many investors sold up last year, and they didn't really need to. I guess one way of looking at it is imagine how much stuff you'd have to make up if you were forced to talk 24/7. Remember, that's really what watching the financial news on TV or in the media is like. You've just got to come up with new stuff every day. The fourth lesson is take economic forecasts with a grain of salt. I guess it sort of follows on what we said a moment ago. Remember all those forecasts that unemployment would reach 10% or more, or those of property values dropping 20% or more? They didn't come to fruition, did they? Similarly, if you're reading something frightening in the business section or hearing it on TV or getting it in the media or learning about it from your neighbour, it's almost certainly too late to act because the information's already reflected in the market. It's either in the share price or the property price. There are people smarter than you knowing what's going on. The problem with economic forecasting is the things you can predict tend not to matter. And the things that you can't predict, they're the ones that tend to make all the difference. The fifth lesson to take into the new year, into 2024, is don't believe all the doomsayers, because there's always going to be somebody out there telling you not to invest in property. Remember at the beginning of the pandemic, the doomsayers, they found their moment. They got all excited. They told us how the property markets would crash. They were wrong, of course. Then they're out once again telling us about inflation and rising interest rates and mortgage defaults. They were going to cause the property market to crash. My message is don't listen to the property pessimists or negative Nellies, the so-called experts looking for a headline, who keep telling anyone who wants to listen to them, and the media likes listening to them, they tell anyone who wants to listen to them that real estate Armageddon's ahead of us. Of course, there's nothing new about these doomsayers. They've been peddling their forecasts for decades. There's always going to be somebody wanting to stall the aspirations of their fellow Australians who are looking to take their financial future in their own hands. There are always going to be people wanting to stop you moving forward. Don't let them stop you achieving your financial dreams, because the doomsayers are always wrong, well, at least in the long term. So predictions, opinions and forecasts should be, in fact, discounted by the number of people making them on the media or in TV each week. Lesson number 6. No one really knows what's going to happen to our property markets. So I guess there's a bit of a theme to these lessons, aren't there? Be careful whose forecast you listen to. You've probably heard me say before, there are 25 million property experts in Australia. Everyone seems to have an opinion about property, don't they? But you know what they say about opinions? They're like belly buttons. Everyone has one, but they're basically useful. So my message is be careful who you listen to. Again, all the respected economists got their predictions wrong in 2020, in 2021 and 2023, didn't they? One year after the other. So if you based your investment on their forecasts, you would have missed some great opportunities. So as a real estate investor, well, it's important to have mentors. Make sure you're listening to somebody who's not only built their own substantial property portfolio, but somebody who's kept their wealth through a number of cycles. Somebody who's been around the block a few times and can see patterns where others see chaos. See, at the moment, there's just too many enthusiastic amateurs out there offering investment advice. See, there's no real criteria for who can't give investment advice, who can call themselves a buyer's agent. Now, I'm not saying these people are unscrupulous and trying to do the wrong thing. They're, as I call them, enthusiastic amateurs who just haven't got the perspective to offer the right advice. So don't let them learn about the markets on your property investments. I remember a great buyer's agent in Sydney made an interesting comment a few months ago on Instagram saying you wouldn't give your keys to your Porsche to a P-plater, would you? So be careful who you use as a buyer's agent to get advice from. I guess there's two types of information. Stuff you're still going to care about in the future and stuff that matters less and less over time. Long-term versus expiring knowledge. And it's critical to identify which is which when it comes to viewing all this stuff that's happening in the media, or stuff that's happening in the economy, things that are happening to our property markets. And while a lot of people are reading data and offering you good advice, or what they hope is good advice based on data, you can make data say almost anything. So what you really need is perspective, as I said, to see patterns, to simplify it in some ways. I guess that's part of the reason that we have been successful at Metropole. I've been involved in property for well over 5 decades now. Now, I didn't know any of this stuff a while ago, and this is again why I'm offering you this type of information, because I want to look back and learn lessons each year. But having been through quite a few cycles, I think if you've been following my podcast or our YouTube videos or my Property Update blog, I hope you subscribe to Property Update. There were about 2.5 million unique readers to it in 2023. So that's a huge percentage of the adult population of Australia. You're going to get information from experts who've been around the block a few times. Okay, the next lesson, lesson 7, boy, I've got to come up with 23 lessons for 2023, but let's see how we go. The next lesson is there's no such thing as the Australian property market. See, the media talks a lot about the Australian market, but there's multiple markets. Each state is actually at its own particular stage of the property cycle. And as you look at the results that we achieved in 2023, some markets strongly outperformed others. Some states did very, very well. Perth, Brisbane, Sydney performed much more strongly than the other states. But then within each state there are multiple submarkets, depending upon price point, geography and property type. So even though the Melbourne property market didn't perform very strongly in 2023, certain segments of it did. This means you've got to understand that despite all Australians enjoying the same interest rate environment, the same tax system, the same government, some property markets will always outperform. But there's nothing new about this. Local factors have always driven property market performance. So avoid paying attention to the commentary that gives broad generalisations about the Australian market or the Melbourne or the Sydney or the Brisbane property market. That lesson I'd like to leave you with that I took out of 2023 is don't try and time the property market. So even though with all the research available in today's information age, I guess you've realised by now, economists can never agree on where our property markets are heading. And as we've already said, they usually get their forecasts wrong. And that's because market movements are far from an exact science. It's much more than just the fundamentals. Hey, they're really easy to quantify. It's an overriding factor of consumer sentiment, buyer sentiment, investor sentiment. So rather than trying to time your investment purchases or selling your property, if you buy the right investment grade assets, time in the market is much, much more important to you than timing the market. And if you think about it, the top and the bottom of the market are really only 1 or 2 days or weeks or months of the cycle. So all those who are waiting for all the news to be right in 2023 missed the bottom, which was in January. And again, sure, there's lots of reasons not to invest this year in 2024, but there's lots of reasons to invest, because when you look back, you'll realize that, hey, what I thought was expensive at the time wasn't really. And I guess there's another lesson there. Then number 9 is the crowd is usually wrong. Crowd psychology influences people's investment decisions, but often to their detriment. Investors tend to be the most optimistic near the peak of the cycle, at a time when they probably should be most cautious, and they're most pessimistic when all the doom and gloom's in the media near the bottom of the cycle, like it was at the beginning of 2023 and end of 2022, when there was the least downside. Of course, market sentiment's a key driver to property cycles, and one of the reasons why our markets overreact. They overshoot the mark during booms, and they get a bit too down and depressed during slumps. So I guess the message from this is, remember that each property boom sets us up for the next downturn, just as each downturn sets the scene for the next upswing. I guess part of this lesson is also beware of taking financial cues from people playing a different game than you are. You see, everyone's making a bet on an unknown future. It's only called speculation when you disagree with somebody else's bet, but don't follow what other people are doing just because they're doing it. Especially, last year or so, there was a boom to commercial property. Now, I own a lot of commercial property, and at Metropole, we help a lot of our more advanced clients with commercial property, but they're for advanced investors who are now well past the stage of growing their asset base and wanting to transition more to cash flow. But the crowd psychology of, I need cash flow, and okay, I'm not going to buy regional property, I'll buy commercial property, is very wrong, because it's not the right game for beginners. I've talked about commercial property and the reason why this before, so I won't go into it much now, but I guess I wanted to just remind you that the crowd is usually wrong, and the trends and the fads are usually wrong in the short term. Now, also they're wrong in the long term. I guess they often are a bit right in the short term because they're self-fulfilling, aren't they? The 10th lesson is property investment's a game of finance with some houses thrown in the middle. You've heard me say this over and over again if you're a regular to this podcast. Strategic investors, well, they've got a financial plan, and they buy themselves not just real estate but time. And they do this by having financial buffers. Financial buffers help see them through the ups and downs of the property cycle, and that gives them the capacity to handle fluctuations in interest rates. So our clients at Metropole all have a strategic plan put to them before we even look for a property. The property is the physical manifestation of a whole lot of decisions we've made, and made in the right order with our clients. And because of that, they had the financial buffers in place and didn't need them through COVID, when many of us thought that would be necessary. But boy, did they come in handy in the last year or two as interest rates went up. I guess the next lesson is you'll need a plan. While the property markets will create significant wealth for many Australians, statistics show that around 50% of those who buy a property sell up within the first 3 to 5 years. And those who stay in the investment game, of those, 92% never get past their first or second property. And that's because attaining wealth doesn't happen just like that. It doesn't just work. It's the result of a well-executed plan. I guess planning is bringing your future into the present so you can do something about it now. Now, just to make things clear, buying an investment property is not a strategy. It's important to start with the end game in mind, and then understand what you need to do, what you need not to do also to help achieve the goal. And then you build a plan, a strategy to get there. As I said, the property you eventually buy is going to be the physical manifestation of a whole lot of decisions, and you've got to make them in the right order. But so often I get people leave comments on Property Update or email me, what about this property? What do you think about this suburb? Where should I buy next? That's not the right way to start. The property comes at the end. That's because property investment's a process, not an event. So if you're a beginner, I guess, looking for a time-tested investment strategy, or even if you're established investor who's stuck, maybe you just want a second opinion about how your situation is going, I suggest you allow the team at Metropole to build you a personalised, a customised strategic property plan. Because when you've got a strategic plan, you're much more likely to achieve your financial freedom, the goals that you're wanting to get. Because remember what I said a moment ago, that 92% of investors never get past their first or second property. The most recent Australian Taxation Office statistics showed that there's less than 20,000 investors who own 6 or more properties. But if you have a plan, if you have a strategic property plan, which we put together at Metropole, and by the way, it's not a boilerplate plan, they're individually customised for clients, it helps you see whether your goals are realistic, especially for your timeline. It helps you measure your progress towards your goals, whether your portfolio is working for you or whether it isn't. It helps you find ways to maximise wealth creation through property. Oh, by the way, it also identifies risks you haven't thought of. And I guess the real benefit is you're going to be able to grow your wealth through a property portfolio more safely than the average investor. So why not go to metropole.com.au, by the way, I'll leave a link in the show notes, and find out more about the strategic planning service and discuss your options with us. Have a complimentary chat with one of our wealth strategists. Now, let me just make it clear, the plan is very detailed. So people say, I've got a plan, I've got a goal, I know where I want to go. But our strategic property plan and your plan should contain the following components: an asset accumulation strategy, a manufacturing capital growth strategy. A lot of our clients get involved in development projects for themselves or renovations to manufacture capital growth, a rental growth strategy. Do you have a rental growth strategy? An asset accumulation, but also a tax minimisation strategy. Our strategic property plans include a structure review to make sure you're owning your assets in the right structures. Also, part of it is a finance strategy, including long-term debt reduction and a living off your portfolio strategy. So go to metropole.com.au and learn more about this service and have a chat, discuss your options with one of our wealth strategists. I guess that's one of the reasons why a recent audit of the results of our clients showed that they're 7.3 times more likely than the average investor to own 6 or more properties, because they have a plan, they've made the right decisions, because they got the right advice. As we go through the 23 lessons for 2023 that I'm taking into the new year 2024, the next one is invest for capital growth. It should be the key driver to your investment decisions. Now, I know a lot of people talk about cash flow, but cash flow is important. It keeps you in the game, but it's capital growth that gets you out of the rat race. So smart investors first build their equity and then they convert it to cash flow. At Metropole, our 40 plus years of investment analysis and analysis of investment returns, because we go back as far as the Australian Bureau of Statistics data gives us on every suburb. We've got all that data, but we've also got the ability to interpret it properly. But it shows that properties with higher rental yields generally deliver lower overall returns for investors. Yes, they got higher yield, but not as much capital growth. Our analysis proved that over the medium to long term, properties with lower rental but stronger capital growth tend to deliver significantly higher overall returns. In other words, it's important to look at both your capital growth and your rental return. But cash flow properties, as some people call them, with higher rental yields, deliver returns overall that are lower. Now, remember, a particular property is not cash flow positive or cash flow negative. It really has to do with how you finance the property. But having said that, in some areas, yields are lower, returns are lower, and that's in general because capital growth is higher. And in some locations, investors require higher returns because the growth isn't as much. When you put it all together, if you invest in the more affordable suburbs that deliver a higher level of rental return, expect lower capital growth. You can't achieve capital growth, high capital growth and high rental yield. Well, that's actually not totally true. The way about that and the way I do it is by buying in high growth suburbs and then manufacturing capital growth or manufacturing rental yields through renovations and development. But it also, I guess the point I'm trying to make, maybe not too well at the moment, is that the significant opportunity cost of having underperforming assets in your portfolio. Remember, most of us, all of us, I guess, are capped by how many properties we can buy. So if you can only afford to own, 2 or 3 properties, make sure they're all investment grade properties and that they're working hard for you. See, moving forward, I can see that we're going to have a 2-tier property market. In 2024, our markets are going to be fragmented. It's likely that higher interest rates and inflation, they're going to keep eating away at the average Australian's household budget for some time, and it's going to make property less affordable for many. Of course, Australia's a big country. There are many remote locations where properties remain very affordable. Problem, of course, is no one wants to live there, do they? On the other hand, blue chip property, investment-grade properties, they're going to continue to remain relatively unaffected by the many fluctuations driving our housing markets, primarily due to the consistent lack of supply in those areas, as well as the ongoing aspirational demand from people who can afford to live in these locations. Now, I talk about it a bit, but coronavirus taught us the importance of living in the right location, the right type of property in the right neighbourhood. Now, sure, we're long past COVID. We're in it's gone and forgotten. Not totally true, it's around at the moment, but in this COVID normal world, people are going to pay a premium for the ability to work, live and play within 20-minute, bike ride, drive, walk from home. They're going to look for such things as shopping, business services, education, community facilities, recreation, sporting resources, and sometimes their jobs, all within a 20-minute reach. Residents of these neighbourhoods have actually come to appreciate the ability to be out and about in the streets, socialising, supporting local businesses, being involved in local schools, enjoying local parks. And I believe as obtaining finance is going to remain difficult for a while yet, it's going to be the people with the money that drive property prices. Not just locals living in the area, but people who want to move into these better locations. You see, there's always going to be wealthy Australians who are going to be able to and prepared to pay to live in these better locations. Rich people don't buy cheap properties. Currently, there's a lot of talk about the rich getting richer, and those who own A-grade properties, they've got more choices. They can move house, they can right-size using the equity in their home, and others are using the equity in their home acting as the bank of mum and dad, helping their children in the property markets as well. So in my mind, the gap will only widen between the wealth of those who own quality property assets and those who don't. The 13th lesson I'd like to share with you is there's always going to be a reason not to invest. Every year brings its own set of crises and lots of reasons not to invest. Look, you can go back as far as you want in history and you won't find a crisis-free year. Sure, some years are worse than others, but there's always bad news. And much of it's unexpected. Where investors get into trouble is rather than focusing on the long term, like I've mentioned before, they just see these crises as a once-in-a-generation event that's going to alter the course of history, when in reality, they're just the normal path of history. And that's what I was getting at a while ago when I was mentioning the concept that you need advisors who've been round the block a few times, who see patterns in the chaos rather than get concerned by it. And that's what you get with the team at Metropole. Okay. 14th lesson, property investment's risky in the short term, but secure in the long term. Wasn't that long ago, 2022 reminded many property investors that real estate isn't a way to get rich quickly. It reminded us property values don't always increase. But that's just the way the market behaves. What happens is that there are in every state long periods when property values remain flat and then fall and then rise again. So property values don't go up consistently, and in every state there are years when the market just remains flat for a while. But there's eventually what we call mean reversion. It comes back to the long-term averages. And those who stay in the game benefit from the power of compounding growth, which builds wealth. But it takes time. Every past decline looks like an opportunity, but every future decline looks like a risk, doesn't it? I found it takes the average property investor around 30 years to become financially independent. It takes that long to build a substantial enough portfolio to live off your property portfolio, often because the first 10 years or so people learn what not to do and they get it wrong. The problem is most don't make it that long because they can't stay the distance, in part because they haven't got good cash flow management. Many people get into property investment to improve their cash flow. That's why they're looking for cash flow positive properties. But if they didn't have good money habits to start with, taking on more debt only compounds their problems. So the lesson is property investment's risky, but you can minimise the risk if you have a strategic plan and a good team around you. The next lesson is plan for the worst and look forward to the best. As a property investor, I protect myself from challenges in our markets by owning the right assets, investment-grade properties in desirable locations, having multiple streams of income from a diversified portfolio. I've got a portfolio of residential, commercial, industrial properties, as well as shares. I own my assets in the correct structures that protect my interests and that are tax effective. Again, part of the strategic plan at Metropole is to own your properties in the right asset structures. That's what Ken Race and his team at Metropole Wealth Advisory will help you. If you're not sure you own your properties in the right structures, go to metropole.com.au and leave your details so we can have a quick chat with you, because we offer a service called a structure review just to see, are you on the right track? Now, I was going back with how I plan for the worst, even though I look forward to the best. So I own the right assets, have multiple streams of income, own them in the right structures, set up cash flow buffers to see me through difficult times, and protect myself and my assets with adequate insurance. Now, fortunately, I didn't really need to rely on these protections I put in place before the challenging couple of years we've had, but having them in place helped me sleep much, much better. You see, I've learned to protect myself and my investments because I don't actually make forecasts. Instead, I have expectations. Now, there's a big difference between forecasts and expectations. I expect there's going to be another recession sometime in the next decade, but I don't know when it's going to come. I expect the property markets not to be as strong in the next little while, but then they're going to boom again. But I don't know when. I expect some of the investments I make won't do as well as others, but I don't know which they'll be. I expect interest rates to drop once again. A little bit anyway, but probably not for a while. In fact, I don't know when. I expect another world financial crisis. I've got no idea when it's going to come. Now, these aren't contradictions. They're not a form of cop-out. As I said, there's a big difference between expectations and a forecast. An expectation is an anticipation of how things are likely to play out in the future, based on my perspective of how things have worked in the past. A forecast is putting a time frame to those expectations. Of course, in an ideal world, of course, we'd love to be able to forecast what's ahead for our property markets with a degree of accuracy. But we can't. Can't you see that that's what the last couple of years of all these false forecasts have shown? We can't, because there are just too many moving parts. Sure, there are all those statistics that are easy to quantify, but it's hard to identify how millions of strangers are going to act in response to the prevailing economic and political issues. And then there's always going to be those X factors that crop up, like I mentioned. So I plan for the worst, but expect the best. Planning is important, but the most important part of the plan is for you, I guess, expecting your plan not to go according to plan, as I said. Now, we're going through 23 lessons from 2023, so you don't repeat the mistakes lots of other people have made in property investment. And one of them is you can't rely on one stream of income. You've probably noticed that successful property investors, business owners and entrepreneurs enjoy multiple streams of incomes. They strategically go to great lengths to make sure they've got money coming in from all directions. In other words, they don't have all their eggs in one basket. Unfortunately, many Australians learned that the hard way during the years of the pandemic, with some losing their jobs, others having to have their work hours cut back, yet others losing their life savings, as unfortunately many small businesses went broke. There's always going to be issues to contend with. It may not be a pandemic next time, but it could be a personal health issue or your inability to work. Sure, it's hard enough for some people to figure out how to create a single source of income, let alone multiple sources. But in my mind, you've got no choice. Rather than relying on your job as an income source, my suggestion is at least start off by becoming financially fluent, learn to invest, and over time, not straight away, over time, develop multiple streams of income. The 17th lesson is there's always going to be risk associated with investing. But my recommendation is don't be afraid of failing, because the biggest risk is not doing anything to protect your financial future. Sometimes negative experiences, mistakes and failures can be even better than success because they teach you something new. Another win probably wouldn't teach you that. One tends to maybe become a little bit arrogant and egotistical and bloated if you're too successful too soon. However, we're often driven to get things right, so driven that we see don't really see the value in getting things wrong. Instead, we tend to spend our time wishing we'd done it differently or not doing anything at all because the fear of making mistakes paralyzes us. If you get it wrong, just learn from your mistakes and make it count by doing things differently next time. One failure can, and with time, can create many successes. So, in my mind, risk management is less about how you respond to risk and more about recognizing how many things can actually go wrong before they do. The 18th lesson I want to share with you is cautious optimism is better for your investment health than perma-pessimism. Let's be blunt, life isn't fair. Get used to it. But having said that, optimists are much more successful in all areas of their lives than pessimists, or so-called realists, who I think are just pessimists in disguise. And this is just as important in the realm of investing. Now, this doesn't mean that you're necessarily going to be happy and smiling all day. It does mean, though, that you can have the ability to look at a situation, and while it might be tough, you're going to be able to see around the corner, see the possibilities rather than the difficulties. Those who have high expectations usually rise up to meet them. Now, pessimism often sounds smarter than optimism, because optimists sound like a sales pitch and pessimists sound like somebody trying to help you. The 19th lesson that I learned from 2023 is time is a limited resource. Don't waste it. Now, we've all got 1,440 minutes every day, but some of us squander it, waste it, or don't use it efficiently. I remember living through 260 days of COVID-related lockdowns in Melbourne a few years ago. I remember it reminded me how truly valuable time is. You can lose money, but you can get it back again. If you're sick, hopefully you can often get your health back again. But once time's gone, it's gone. It's irretrievable. So start to capitalise on your time, the time you've got, and get a whole lot more done. The problem is most people confuse moving with progress. Just because you're getting a lot done doesn't mean you're getting the right things done. I found many people just seem to be running in the same place. Interestingly, over COVID, working from home has made me much more efficient, and I've now only worked from home. As you probably know, I've stepped back as the CEO of Metropole, and Mark Reedon now runs the day-to-day part of the business, but I'm still very active, and I get a lot done in those 1,440 minutes I have every day. Another way of looking at time was brought home to me, I guess, over the last years, and it's that life is short. On some levels, most of us know life is short, but the year showed that to me when a number of people I knew well are not with us anymore. So I guess the last year taught me, we don't get a second chance. It's important to truly appreciate what we've got, who we're living with, and live your life to the fullest. The 20th lesson is the only certainty is change. Now, we all face change every day, whether it's as simple as change in the weather or something significant as another wave of coronavirus going to come and get us. I hope not. Change is just a normal part of life. The problem is most of us don't like change. We like certainty. However, learning to expect change has brought me hope during the challenging and unexpected life events that I've experienced. I've come to realise it's not the circumstances or the change that dictate how my life is going to go, but rather how I handle those changes, how I handle those disruptions. Rather than worrying about all the changes occurring, I've learned the concept of having a useful belief about the changes that are happening to me and seeing what good will come of them. So what I look for is, hey, what good is there? What useful belief do I get out of this? I feel more in control of my life by doing that. I feel more comfortable. The more comfortable I feel, the better I perform in all areas of my life. So the 21st lesson I want to share with you is worry better. Fact is, most things you fear are never going to happen. They won't happen. It's just the monsters in your mind. And if they do happen, most likely they're not going to be as bad as you expected. But forget the saying, don't worry, be happy. Remember, there was a song about that, don't worry, be happy. Instead, worry the right way. It's better than not worrying at all. You see, worry can play an important role in your life, but it doesn't have to be destructive. Look, we're all wired to worry. That's because worry has an evolutionary benefit. It drew our attention to the fact that there were some things that you should be doing while there are other things that should be avoided. Those who worried correctly survived. They evolved. But today, time spent worrying is time you could spend identifying opportunities or taking action. Worrying about the right things can motivate you, but if you find it unproductive, try and take your mind off things for a while. Try and engage in other activities. I've actually learned the trick of limiting the amount of time I worry. I was taught this concept a while ago. I tell myself to put a limit of, say, 5 minutes, 10 minutes on my worrying. This is my worrying time, and then force myself to move on and focus on other tasks. Hey, that's a good trick to learn. The 22nd lesson I got out of 2022 is this too shall pass. How often do we need to hear the world as we know it's going to come to an end before we realise that the world as we know it is not going to come to an end? I've learned that making long-term investment decisions based on short-term concerns, that's not a recipe for success. So the lesson, 2024 is going to bring its own events that are going to dictate our lives in financial markets and market sentiment, often for a few months. I recommend you prepare yourself to see these for what they are, a distraction to your long-term investment goals. And the last lesson for 2023, I guess, was that 2023 was the year of artificial intelligence. I remember learning about ChatGPT from my son Bryce. He taught me about it. He showed me when it first came out in November 2022. And 2023 was the year when many of us learned about AI and ChatGPT. And we're still trying to work out how it's going to play out in our property investments. I think property technology is going to be revolutionising and transforming the property landscape. Moving forward, it's likely you're going to be utilising tools and platforms that would streamline your investment process, give you good insights and manage your properties efficiently. Well, the bottom line from this long chat I've had with you today is that 2023 may have thrown you some curveballs, but it's also presented us with some valuable lessons as property investors. By embracing these insights, adapting to the changing landscape, and remaining focused on your long-term goals, you should be able to navigate the current markets, the markets of 2024, and build a successful portfolio to secure your financial future. And I hope you're going to be coming back twice a week with the Michael Yardney podcast to allow me to help you get that financial future you deserve. I hope you got some benefit from my reminiscence and my lessons. And if you did, but you don't currently subscribe to this podcast, just stop before we do the next couple of sections and just register so that you get the regular downloads of the information my guests and I share with you. By the way, I've also got a bonus way of saying thank you. Go to podcastbonus.com.au and you can download a heap of ebooks and reports. Again, my gift, my way of saying thank you. But since you subscribe to this podcast, since you listen to my commentary, I presume you're already successful at what you want to do, but you're driven to move to the next level. You're driven to keep your income growing. You're driven to build an impressive asset base that's eventually going to give you the family, you and your family, the lifestyle choices that you're looking for, the financial freedom you're looking for. Hey, does that sound like you? And I assume you'd relish the opportunity to meet and be influenced by a high level of like-minded high achievers such as you. And I guess you're also keen to learn and get a large pool of breakthrough income-boosting property, entrepreneurial, finance and business strategies. Now, I've got that available for you. I've got that available for you at Wealth Retreat. We're going to be holding Wealth Retreat on the Gold Coast at the end of April, and I've put together the best faculty of property, economic and business people I could, finance experts, so that you can take advantage of the current property cycle. So go to wealthretreat.com.au, find out all about it, look at our expert faculty, and put me to the test, because I speak to everybody who's keen to join to make sure it works for you. And if you do join, if you're prepared to come, I'll back you with my money-back guarantee. Put me to the test. Go to wealthretreat.com.au and don't count yourself out, even if you're not at the level you want to be yet. Maybe this is your opportunity to get there.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
Today, in my mindset message, I'd like to talk to you about ways to improve your life satisfaction. And I got the concept for today's chat from a blog I read from Rob Dix, who interestingly runs a British property podcast. And I was interested to read that he said that happiness is the art of wanting what you already have. Isn't that interesting? Let me repeat that. I think it's worth it. Happiness is the art of wanting what you already have. Now, somehow, without trying, I think I've actually got this attitude. I'm happy with my life. When I'm at home in Melbourne, I'm happy here in Melbourne. When Pam and I travel overseas, not that we've done it this year, when we're travelling, I never want to come back. I'm happy with that. I'm happy with the food I've chosen at the restaurants. I think it's actually quite good. I don't actually say, oh, gee, that meal over there looks good. I don't want to swap my problems for somebody other problems when things go wrong either. In other words, the grass is always greener on my side of the fence than it is on the other side of the fence. And that's good. I'm happy pretty much of the time, and I don't really experience any sort of jealousy. Now, I know you could be saying, well, that's easy for you, Michael, because you've been lucky or you've achieved a lot and you're wealthy, and you're entirely right. But I also know plenty of extremely unhappy people with great material wealth and what others would consider wonderful lives. So I believe this wanting what you have attitude can be practiced whatever your current situation. So how do you do this? Well, I think the first thing you should do is practice noticing what's great about what you've got. You see, our mind has evolved to notice what's not good about our current situation, and that's on purpose to help us strive to improve. I think about it, if our ancestors sat around being thrilled that they had one bucket of grain to last them through the whole winter, none of us would be here today. So we unconsciously go through our day noticing that our house is too small, our children are being difficult, our job is dreary. So to counter this, my suggestion is to develop the habit of noticing what's great about what you've got. Your house is situated in a great suburb. Your kids are spirited. They're inquisitive. Your job has got great potential, and you've got the ability to then go home after your job and enjoy your life. So at the start, this is something you've sort of got to consciously force yourself to do. And I learned this technique many, many years ago. So every morning when I get up, I think of a list of things that I'm grateful for. I do that every day. And it's usually about 5 things. And it's got to be different from the day before. Otherwise, you sort of cheat, don't you? Over time, though, this becomes a habit, crowding out the habit of noticing what you're not happy with. The second way to be more happy with what you've got in your life at the moment is to speculate about what's bad in somebody else's situation. Now, again, a natural instinct, and that's particularly more obvious today in the days of social media, is to look at somebody else's possessions or situations or jobs and want that for ourselves. It's difficult to want what we have, to be happy with what we've got when we're busy wanting what somebody else has got. So I'm going to suggest you try the habit of reverse jealousy. Go out of your way to point out what might not be so good about somebody else's situation. Wow, the logistics of staffing that business with 60, 80 employees and all the hassles that come with that must be a nightmare. Oh, look, that kid, he may be really good at sport, but he actually doesn't have much of a social life because every weekend he's got to be training. Oh, he must be constantly worried about his beautiful new Lamborghini car that people are going to scratch it if he takes it out in public. So now, long term, this isn't healthy. I'm not suggesting that you shouldn't be happy for other people's success. In fact, that's one of the traits of successful people, that they're happy when other people are successful. But I'm suggesting this more as a deprogramming exercise to kickstart your own satisfaction, flipping your potential jealousy for other people, noticing, hey, what's not so good about it? Because remember, we tend to see our problems in more detail than others. There's no such thing as a perfect marriage, a perfect business, a perfect job, a perfect house, a fantastic property portfolio, a perfect health, or a perfect anything, really. We've all got worries, insecurities, frustrations, niggles, aches and pains, and there's a myriad of ways. Everyone's life is far from perfect. It's just when you've got a front row seat for these imperfections in your own life and you only see others fleetingly or from a distance, this magnifies what you see as your own problems. And of course, as I said a moment ago, social media, where people go out of their way to present a very filtered, staged, managed image of what their perfect life is, that makes it hard for us to compare what's going on with our life. So it's important to remind yourself of this frequently until you internalise it, that, hey, that's not the real world. Reality TV isn't real either. Otherwise, you can never be happy with what you got because you're never going to live up to that illusionary perception of what other people have got. Now, another thing you should do is balance happiness with a drive to improve and progress. Like I said, persistent dissatisfaction is a powerful motivator. So if you become too satisfied with your lot in life, it may end up losing your drive. So I suggest you really got to balance the two. When it comes to your possessions and your family and your standing in life, you should want what you have, making sure you keep harmful envy at bay and appreciate the small moments that you have each day. And a lot of us who've had to stay home, be more locked up through COVID, have suddenly learned to appreciate different things, haven't they? But it's also okay to be dissatisfied with your professional progress or your sporting prowess or your ability to understand a particular problem or subject or your station in life. You want to get better and you want to not compare with other people, but you want to do better for yourself. So as long as it doesn't become an obsession and sits within the framework of your overall life happiness, wanting more than you've currently got is actually a good, useful, powerful motivator. Well, thanks for spending the last little while with me, and I hope you got some benefit from this show. If you did, and you know somebody else who'd also benefit, please tell them about the Michael Yardney podcast. There's a share button on every podcast app. On Apple Podcasts, there's 3 little buttons down the bottom. Press it and share it, or just tell them about the Michael Yardney podcast. I hope you're going to be doing them a favour, and you'll definitely be doing me a favour and helping me in my quest to make as many people as possible financially literate. Now, there's ways of catching up with me between these shows. Just look for Michael Yardney on social media, or why not join my private Facebook group? Go to Facebook and look for the Property Update Facebook group. And I have a way of saying thank you to you for subscribing to this podcast. Go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where you can get a bunch of ebooks and reports. My way of saying thank you. And when you've got time, why not listen to some of the old podcasts? There's individual lessons in each of those that I think would be helpful for you. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?